A couple of weeks ago, I was at an event and I was talking to business owners, and the topic of software came up, and specifically the amount of money that people are spending on software. And look, at the end of the day, software is expensive. There's no denying it. And every business needs some level of software to operate. I mean, you don't have to have software. It is possible to operate a business without software. But yeah, software surely does make things better. But one of the business owners I was talking to, he's a newer business, revenues of $1,500 a month or less, spending $800 a month on software. It's really comes out of talking to other peers like, oh, I'm using this software for this and I'm using that for that, and we should do this with automation. I think the problem is that we can look at spending all kinds of money to automate our businesses. But at the end of the day, there's one thing I want you to remember. Software does not mean sales. And we'll talk about it in this particular episode. But there was something else that happened at that event, something that kind of caught me, a thought process that I had. And I'm thinking, this guy is working in his business to fund the SaaS subscriptions, and they're not going to be able to gain traction. I've seen this play out so many times where so much of the revenue goes to pay for these software expenses and subscriptions that you just begin to feel defeated. Am I ever going to get there? Now, today I'm going to put on the three hats that I love to wear: the operations hat, the finance hat, and the technology hat. And really, here's the irony of this whole thing. What you're about to hear is from somebody who built a SaaS product that's used by hundreds of people monthly. And quite frankly, I'm like always one of the slowest people in the room to add a new software. Someone will say, you should do this. And I'm like, yeah, maybe. I don't like to change software. I love software. I'm a tech-driven person, but I don't love introducing new software into my business. And I definitely don't like introducing it to my team because I like stability. So I'm not here to talk to you about being anti-tech, because I'm not. I'm really here to talk to you about anti-waste. How do we get into the right mindset so that we focus on what's at hand right now, the problems that we have right now, and we let software fix or come into the play when it's there? All right. So first, operations hat comes on. And the thing that I want to really talk about here is that software, while it can be seen as good, it does create obligations. The first thing about software that's important to understand is that when someone is starting a new job, there's already a big learning curve to a job. So they have to learn how you operate. They have to understand the environment in which you're operating, how you do things. And from an operational standpoint, that is a huge cognitive load on somebody. But then we compound it when we have to now learn software with the job. It's one thing to know the job and to try to come up to speed on it. It's another thing to learn the software that supports the job. So software from an operational standpoint can gain efficiencies. It can also create a load that creates other obligations. Obligations to train a new employee on how to use the software, obligations from you as the operator for maintenance and integrations and updates and monitoring, all that stuff. Every tool that we interject into the company is really a commitment to more attention. There's a joke I heard once about technology, and they said, you're not buying a solution, you're simply hiring a needy employee. And that is true, because whenever we add something to our operations, we add complexity, even if it's designed to take complexity out. So when we understand it from that perspective, maybe we see one side of the equation there. But let's talk about it from a finance standpoint. The math, it just sometimes just doesn't add up. Everything has to fit in and be kind of supported by the company. And what I mean by that is, I think about from a finance perspective, I'm always thinking about a percent of revenue. This line item, let's say SaaS, for example, software as a service, I look at the line item and I expect it to be within some percentage. I think in percentages when I think about financials, profit and loss statements. For example, if my revenue is 100% of all the money coming into the business, Well, then my cost of goods sold needs to be some portion of that. Let's say, I don't know, 30 to 40%. And then salaries and payroll should be 20%. And software should be 5 to 10%. Okay, that's my rule of thumb. But every business can also be different, because if you're running a technology business, for example, maybe software is a more expensive part of your profit and loss statement. It's 30%. So it really just depends on the individual business. But most businesses, I think that it's fair to say 5 to 10% of your revenue. When you're spending 50, 60% of your revenue on software, red alert, you're in a death spiral. But I expect something else from my software. And what I expect is a return on investment. Every dollar that I spend, every dollar that's an expense on my P&L needs to have a return on investment. I expect a return on investment from my software. And how do I get it? How do I measure it? After 12 months or so, I want to see that I've got a 2x return on my spend. I want to be able to quantify this in some way. Software companies love to tell you about all the efficiencies that you're going to gain, all the hours that you're going to save. But what I want to see is real savings. When I introduce a software into something, I want to be able to say, this process took me 20 minutes and now it's 60 seconds. And that's something that actually happened in my business. We had a process that was not automated. It took 20 minutes to do. And when I introduced automation into it and showed the team how to automate that component of it, we dropped it to 60 seconds. That's a 2,000% improvement. That's a 95% gain in efficiencies. That is something that there's an ROI to. And I would expect that software to be able to cover that. These are actual savings, not theoretical savings. When we try to add technology too early into the business, before we have people, before we have revenue, then we're never going to be able to calculate revenue gains or the profitability gains that the software is contributing to. It's going to be theoretical, not actual, because we don't have any baselines to go by. Now, let me put on the third hat here, the technology hat, and argue from that perspective. Look, technology does drive efficiencies. I'm not here to deny that. Software can make you more efficient. It can move things along faster. I just gave you the argument that I had a process that took 20 minutes. We got it down to 60 seconds. That is real efficiencies. That's real benefits to the company. The particular employee that I'm telling you about that managed that function, he told me his entire day was spent watching for an email to come in that an order had been placed. He would then go in there and process it for 20 minutes each. So if he got 3 orders in an hour, he was at capacity. Because it's automated, he watches it 3 times a day, morning, noon, and before he leaves for the day. In my own real estate business, when I introduced software in the form of a CRM, it generated sales. But I didn't do that CRM from day one. I had revenue already in the business to support the investment in the software. One of my favorite audio bites is from Paul Graham. Paul Graham is the founder of Y Combinator. Let's listen to this audio clip.
What doing things that don't scale means specifically is doing things in a sort of handmade, artisanal, painstaking way that you feel like, yeah, it would be great if you could do things that way forever. But you're in the back of your mind, you think to yourself, well, there's no way we could keep doing this and become giant, right? And what do things that don't scale means is do those things early on anyway, because if you don't do them, you'll never be big. So you got nothing to lose. And also you learn a lot from it. You learn a lot. And so I discovered a lot of these things that we teach startups at Y Combinator, or you teach startups at Y Combinator. I'm retired. I don't know if you know that. But a lot of things you guys teach startups are things that I hit myself and didn't realize that they were actually common startup lessons. So one of them is doing things very manually for your early customers. Like, it's so important to get early customers that if you have to do a ton of manual stuff, that's okay. You'll learn a lot from it.
So the point is we want to get involved and to get dirty and to do the things that doesn't scale. So we want to focus on that because that's going to give us what we need to connect with our customers, to connect with our business. So what I encourage you to do is to stop messing around with the automations and the efficiencies, and we need to get to the core, which is deal flow. And that's what you're seeing here. It's like this move. We're going to take this move and build this whole concept down, push it down into the software, because at the end of the day, when you need deal flow, which means that you need revenue, software is not going to generate the revenue. Remember, software enters higher up into the order level. What I did was I stayed lean. I stayed technology lean. I spent very little dollars on technology. I did the bare minimum. And when I needed to have software, if I could find the free version, I did it. The other thing that I didn't want to do is commit to a software only to turn around and have to change software later. There's friction in there, and I get it. I didn't want to do that either. But I did find some good free resources that I used. Now, if you're sitting on this podcast and you're feeling uncomfortable, maybe you feel like I'm calling you out. I'm not trying to call you out. I'm hoping to give you a different way of thinking about this. But maybe you're thinking, man, I'm higher to the 10%. What do I do? Well, I hate to break bad news to you, but here it comes. You're going to have to reduce. You're going to have to downsize your software. We have to cut the bloat. That's the only way we can fix this problem. This does not apply just to startups either. I'm telling you, I've done it. I've looked at my software explode sometimes. I have to step back and be like, what are we doing? It's a lot like streaming services. Can we just go back to cable TV where we paid one price? I still have cable and I have all these other subscriptions. And guess what? I can't find where anything is. I need a TV guide for the streaming services. Someone please bring back TV guide. Okay, I digress. How do we fix this? What do we have to do? Well, you're going to have to abandon what you've done, and that's painful. Some of you are like, brutal. At the end of the day, what it comes down to, as you know, is the sunk cost fallacy. The sunk cost fallacy is basically saying, I've done all this work, or I've spent this money, and if I do all of this and I abandon it, it's gone. True, it's gone. But here's what I really want you thinking about. If you don't get your expenses under control, if you don't get these expenses under control, then you're going to become resentful of your business. You're going to feel everything that you're working for is going for subscriptions. You're going to get burnt out and you're going to quit. And if that happens, guess what? You just lost all the work that you did. So either way here, you're probably going to go and lose some work. You're either going to lose it and you can build back onto in the future. You've learned a lesson. You're going to be able to pick up on that. Or worst case scenario, your business doesn't survive because it burned you out. And if that's the case, well, then you lost all the work anyway. And that's the whole point here is I'm trying to stop you from getting burnt out or from having to feel like you're working for these software subscriptions so that you can move forward. This whole thing reminds me of the opening story from the book Fix This Next for real estate investors. Because the very first story I talk about a business owner who was calling it a day. He's like, I'm done. And I hear these stories quite often and they're sad to me. They're sad because I know that somebody is giving up on their dreams, at least for this moment. And I hate when that happens. I also want to give you emotional permission to cutting back the software. The software you bought early on is a tool. If you're not maximizing that tool, or if that tool is not working for you, if it's not producing the revenue or the efficiencies that you can quantify, send it walking, send it packing. The whole thing, this whole software thing really reminds me of the 1848 gold rush. You know, gold miners, they found gold in California. People were rushing out to California. And the miners, yeah, some of them made money. Some of them broke even. Some of them lost money. But the people that made the money were the suppliers of the tools. It was the suppliers of the tools that got rich. Levi Strauss is one of them. So the SaaS companies today, they're the ones that are convincing you that you have to have their tool so that you can strike the gold. But guess what? You really don't. I joke that my business had $5,000 of revenue. I think it was like $4,800 in revenue. Let's call it $5,000. And I hired a sales rep. And the first thing she said to me is, where's all the leads? And I'm like, well, I keep all the leads on index cards. I love index cards. I keep them all on index cards. I just filter through them. This is who I got to call back. Next call back. It's the old school way. And she's like, well, we really need a CRM. And I'm like, okay, I agree with you. I got her a CRM. I did the cheapest one I could find. I think it was like $25 a month. That's it. There was nothing fancy to it. There was no real automations built in there. She didn't earn them out yet. The business hadn't got to that point. So once we got to the $5,000 range, we added a CRM. Once we got to, $7,500, we started looking at some ways to automate the workflow that she was doing. The business had to earn the tool. The business had to earn the software. And if it doesn't, well, then it doesn't get it. It doesn't get the software until it earns the software. All right, so how are we going to fix this? Simple. We're going to go cheap. We're going to find software that fits our budget. If that means we have to leave behind what we've done, so be it. You might think, I just lost a boatload of work. I hear you. Now, look, if you think you can get the revenue up to support it, or you think that you can survive the drain, and you're not going to be upset about the money that you're sinking into the software, that's your business choice. That's fine. I'm not telling you have to do it this way. It's really up to you. Everything's up to you. But here's how I would do it. If I need to fix it, there's milestones that say when we add this software back. We do it very, very controlled. We control the funds. We keep them in the right percentage of revenue. And in that case, what we find is we have more control. Do we lose things? Yes. Are we as fancy as the guy next to me who's telling me about all his zaps and all the other stuff? No. Do I care? No, I don't. That's aspirational. And if he wants to go, maybe he has the business revenue to support it. Cool. When I get the business revenue there, I'll support that lifestyle too. Until then, there's lots of free tools that I can use. And that's what we're going to do. We're going to keep our money in our business, because at the end of the day, please remember that software does not make us money. People do, but software does not. And right now, you're the one that's driving all of this. All right. So hopefully that was helpful to you. I'm loving the fact that you're here listening to this and hopefully getting these key takeaways from it. And I will see you in our next show.